it will be 36. And in year 4, it will be 20% of 12 million, 20% of 12 million, which will be 24. And here 10%, which will be 12, which is 12, which is 12, like that. Yes, like that. Yes, and I think in our case, we are basically done. So what now we need to proceed and we determine here is the taxable profit. Is the taxable profit. The taxable profit for the first year, will be what? Will be 24 plus 3,000 minus 48, which is 600. I hope that is what you're getting. So year 2, we have 27, or basically 57 minus 36, which will give us 21. And then here we have 3450. Here we have what? We have 4350, yes. So that basically what was required there, the taxable profit, So assuming the examiner also required you to compute the current tax. How do we compute the current tax? Current tax is equal to the taxable profit, which we have here. We multiply that with what? The tax rate. So let's compute the current tax, though that was not a part of the requirement. So this one should be equal to the tax rate times this. So the taxable profit. So, and if you go back to our question here, in the last paragraph, we are given the corporate tax rate. The corporate tax rate we are told is 30%. So the current tax, remember you say the current tax is the actual tax which the company was supposed to pay. So can we compute this one as 30% of 30% of this one? So this one will be 180. This one will be 630. 630. What about year 3? $10.35. $10.35. And then finally we have what? We have 1305. 1305. That's what you're getting? Yes. So in case you are required to compute that, that's basically how we compute it. So let's move to Roman 2 of the question. Roman 2. So in Roman 2, we are required to compute what? The deferred tax. We are required to compute the deferred tax. Now, the deferred tax, if you can be able to recall in our previous class, we said that this one arises as a result of the difference between the accounting profit and the taxable profit. So the deferred tax arises as a result of the difference between accounting profit and the taxable profit. And I hope you can see in our question here, we have the accounting profit and we have the taxable what? Profit. If you check on these two profits, those two profits, you'll basically be able to see that they are what? They are different. They are what? Different. Sasa? Yes. So therefore, to compute this particular deferred tax, in this case, there are two approaches we can use. We can compute the deferred tax using the income statement approach, because we talked about two approaches of computing the deferred tax, where we use the timing difference. The timing difference is the difference between the accounting profit and taxable profit. Number two, we can compute this deferred tax using the balance sheet approach. We say that the balance sheet approach, we compute the deferred tax using something called the temporary difference. Temporary difference, we say this is the difference between the carrying amount of an asset and the tax base. And the tax what? Base of an asset. And remember, in this case, we have an asset here. An asset which is being depreciated for accounting purpose, and for taxation purpose, the asset qualify for wear and tear charges. And actually, this depreciation and the wear and tear charges are the ones which are making the accounting profit and taxable profit to be difference. So what I want us to do, I want us to use the balance sheet approach. Under the balance sheet approach, approach, approach of computing the deferred tax, we will have to compute the temporary difference. Yes, but in this case, still I'm saying we can use the other approach. But remember, I said the method which is recommended is the balance sheet approach. So meaning that for us to compute this deferred tax, we need to compute the temporary difference. So let's have that computation here. And basically we will do that for 4 years. I want us to arrange our information like this, vertically. So we have our 4 years. The first year ended on which date? 30th of June 2019. The other one 30th of June 2020. The other one 30th of June 2021, and the other one 30th of June 2022. So how do we compute this temporary difference? We compute the carrying amount. We will have here a column for the carrying amount. If you can be able to recall, we said the carrying amount is the value at which an asset or liability is recorded in the statement of financial position. Now, taking into account here, we have one asset, which is plant. Is it plant? Yes, which is equipment, not plant. It is equipment. So the carrying amount of this particular equipment, who can tell us? It should be recorded in the balance sheet at which value? We record equipment in the statement of financial position at which value? Yes, I'm told by Zipporah, we record it at the net book value. That is very much correct, which is equal to the cost minus accumulated depreciation. Then from there, we also need to determine the tax base. So in this case, we say the tax base of an asset, this is equal to the written down value. The written down value of an asset is equal to the cost minus the accumulated wear and tear charges, or minus accumulated capital allowances. Yes. So and then also our figures here will be 1,000 of shillings. Then we get the temporary difference. The temporary difference, which still will be in 1,000 of shillings like such. Yes, so I want us to compute these values here. These values. So let's start by computing the net book value. And basically I've said that this one will be equal to the cost minus accumulated depreciation. That's basically how we compute this. What about this one? This one will be equal to the cost minus the accumulated wear and tear charges. And tear what? Charges. That is basically how we are going to compute the two. So we start with this one. So remember, we are computing the net book value of our equipment. So our equipment had a cost of 12 million at the start of year one. So the net book value at the end of year one, we take this one minus depreciation for year one. Depreciation for year one is 3,000. So that will give us what? That will give us 9,000. I hope you can see what you have done. This minus this. Then in year two, we will take the cost minus depreciation for 2 years. So this minus this minus this, which will give us 6,000. In year three, we take this minus this minus this minus that, which will give us 3,000. In year four, we take this minus this minus this minus this minus that, and basically that will give us what? 0. That will give us what? 0. Those are the carrying amount of the net values. How do we compute this one? The written down value, or the tax base. We take the cost minus accumulated wear and tear charges. Wear and tear charges, we have them here. So in the first year, we will take this minus this for the first year, the wear and tear charge for the first year, which will give us what? Which will give us, is it 72? Yes, 72. In year two, we take this minus this minus this, which will give us what? 36. In year three, we take this minus this, minus this, minus this, which will give us 12. In year 4, this minus this, minus that, plus minus that, minus that, and basically that will give us what? 0. Will give us 0. So having that, we proceed and we compute this one. And remember, we said that the temporary difference which we compute can either be taxable temporary difference or can be deductible temporary difference. We say if you get a positive figure here, a positive figure is a taxable temporary difference. If you get a negative figure, it is a deductible temporary difference. So we take this minus that, which will give us 1800. And that being a positive figure, this one we say is a taxable temporary difference. Let me put it like this, is a taxable temporary difference because it's a positive. If it was a negative, it is a deductible temporary difference. So this minus this, which will give us 24, which is still taxable temporary difference. This minus this will give us 18. It is still taxable temporary difference. This minus this will be 0. So there is no any temporary difference. There is no any temporary difference there. There is no any temporary difference. There is no any temporary difference. And then who can be able to recall? If we have a taxable temporary difference, this will give rise to something called what? A taxable temporary difference. It gives rise to something called what? Who can be able to remember? This is something we discussed in our previous class. We said if a company has a taxable temporary difference, this will give result to something called what? Recall what we discussed. Recall what we discussed. Who can be able to recall? We said that result to something called what? Who can be able to remember? Who can be able to remember? No one who can be able to remember. Yes, yes, I can see Nul. I can see Zipporah. I can see Felix can be able to remember that. We say that that one will basically result to something called the deferred tax liability. Not Raphael, not asset. It should be liability. How do we compute this deferred tax liability? The deferred tax liability is computed by taking this one, taxable temporary difference. We multiply that with the tax rate. We multiply that with what? With the tax rate. So therefore, in this case, we can compute now. Basically, in this, at the end of year 1, 2, and 3, we will have a deferred tax liability. We will have a deferred tax what? Liability. So how do we compute this deferred tax liability? So we use this formula here. The deferred tax liability. The deferred tax liability, we use this formula. So for the first year, the year which ended 30th of June 2019, the deferred tax liability will be equal to the taxable temporary difference, this one. And remember, our figures will be 1,000 of shillings. We multiply that with the tax rate. And that will give us what? That will give us 540. Is that correct? 540? 30% of this? Yes. So in year 2, 30th of June 2020, we take this one, taxable temporary difference, times the tax rate, which will give us 7 what? 720. 30th of June 2021, we take this one, 1800. 1800 times this one, which will give us still 540. Yes. And the last year, 0 times what? 30%, which is basically what? 0. So this is now the deferred tax liability at the end of year 1, year 2, year 3, year 4. Remember, we say that these are taxes to be paid in future. Tax payable in what? The taxable payable in future. So that is it. That basically what was required as far as that question is concerned, the deferred tax liability, the deferred tax liability, the deferred tax liability. And basically we are done. We are done with that question there. So I want us to move to something else, or basically to a different question. To a different question. To a different question. So we can, first of all, look on a small one, and then we wind up. I want us to wind up with that for April 2022. So which one can we check? Yes, can we go to which sitting? December 2020, 2021. Let's go to December 2021. December 2021. December of 2021. December 2021. 2021. Specifically, question number what? We are not doing the entire question of 2021, but can we go to question number 5? Let's go to question number 5. Let's go to question number 5. Basically, we are not doing the entire question, but there is something, there is a note I want us we check there. This question here. Specifically, I want us to check on note number 3. Note number 3, additional information number 3. Additional information number 3. Are you there? Are you there? Are you there? If yes, please confirm. Are you there? If yes, there, please confirm. Please confirm. Please confirm. December 2021. Note number 3. Additional information number 3. Ajara, are you there? Aaron, are you there? Naomi, are you there? ZP, are you there? Felix, Helen, Lucy, are you there? Lucy, are you there? Naomi, Virginia, are you there? Okay, sawa. So what are we told here? What are we told as far as that question is concerned? We're not doing the entire question. So I want us to go to the additional information number 3 and we see what you're told. Basically this, maybe first of all, we can go through paragraph 1. We are told the following trial balance relates to Babu Limited as at 31st of March 2021. So we're given the trial balance of that company. Basically, given us so many items there. Then we have additional information. This is basically our next topic we are doing. So it is known as the topic of preparation of public financial statement. That would be our next topic. So in note number 3, we are told Babu Limited estimated that income tax provision of shillings 113.8 million is required for the year which ended 31st of March 2021. And then you're told the balance on the current tax in the trial balance represent under stroke over provision of the tax liability for the year which ended 31st of March 2020. And then in the other paragraph, you're told as at 31st of March 2021, the tax base of Babu Limited net asset was 292 million less than the carrying amount. And then you're told the income tax rate applicable to this company is 30%. So if you check on that note, the whole of note number 3, it was basically testing it was testing on your knowledge, on the students, on the candidate's knowledge on IAS 12. Are you able to account for the income taxes, both the current tax and also the deferred tax? I want us to go through the note again. We are told in first paragraph, Babu Limited had estimated that income tax provision of 113.8 million is required for the year which ended 31st of March 2021. That is basically the current year. Remember what we said is that as an accountant, when preparing the financial statement at the end of the year, you can't be able to determine the actual tax to be paid because the actual tax to be paid can only be determined after the financial statements have been prepared. So when preparing the financial statement as an accountant, you estimate the tax to be paid. So once you estimate the tax to be paid, you provide for it. You set aside money from the profit to pay that tax once it has been computed. But in this case, we said once you have estimated tax to be paid, you have created a provision. We say that can give rise to over provision or under provision. And actually, we say any over provision, for example, in the current year, should be forwarded to the next financial year and deducted from the estimated to be made in the following financial year. If there is other provision, that other provision still should be taken to the next financial year and added to the estimated tax liability for the following financial year. So we are told during the current year, the company estimated the tax to be paid to be 113.8. And then in the other paragraph, we are told the balance on the current tax in the trial balance represent under stroke over provision of the tax liability for the year which ended 31st of March 2020. So in the previous year, we are told there was over stroke under provision of tax. But in this case, you can see the examiner is not specific whether it was over or under. If you can be able to recall what we said on Saturday, we say that in case you're given an item or you're given current tax in the trial balance, and the examiner tells you that this is an over or basically under provision, is upon you to do what? To determine whether that is over or under, because we said the examiner will not basically specify whether it is over or under. So we said in case this item of current tax is given on the credit side of the trial balance, then we say it is what? It is over. So if that amount is given on the credit side of the trial balance, it is over provision. If it is given on the debit side of the trial balance, it is what? It is under provision. That is what you need to remember here. So therefore, can we go back to the trial balance and you tell me how much is that amount of current tax? How much is the amount for current tax? The amount for current tax, we have it where? We have it, I can see it above the revenue. Above the revenue, can you see that down there? Above the revenue. And that amount of current tax is given as 12,800. So being 12,800 and it is on the credit side of the trial balance, is it over or under provision? It is on the credit side of the trial balance. Is it over or under? Remember what you have said here. Is it over or under? So this one, because it is on the credit side, this one is over. This one is over provision, over current tax, of current tax in the previous year. Remember the current year ended 2021. So the previous year ended 31st of March 2020. So how do we account for this particular over provision of current tax from the previous year? So we bring it to the current year, which is the year 2021, and basically we less it from the estimated tax liability. Remember in paragraph 1 of note 3, we are told that this company, Babu Limited, estimated the tax, the income tax for the current year is 113.8. So that is the estimated tax liability for the current year. So therefore, in this case, even before we go to the last paragraph, we need to compute something called the current tax. Current tax to be charged. Current tax to be charged in the income statement. Current tax to be charged in the income statement for the year which ended 31st of March 2021, which is the current year. So how do we compute this one? The current tax to be charged in the income statement for the current year. One, we take the estimated tax liability. Estimated tax liability. So the estimated tax liability, this is the tax the company estimated was supposed to be paid during the current year. So this is the estimated tax liability for the year which ended 31st of March 2021. And in our case, in sentence number 1 of note 3, we are told that is 113.8. But if you check the figures in the trial balance, the figures are given in thousand of shillings. So we need to be consistent. And also this one, we take it in thousand of shillings. So it will be 113. It will be 113,800. And then remember in the previous year, 2020, there was over provision. Remember, this over provision in 2020 will be brought to the current year, 2021, and basically be what? Be deducted from this. Be deducted from this. If it was under provision, we still bring it to the current year and we add it to this. But take into account it is an over provision. So we do what? We left it here. So over provision of current tax from the previous year, the year which ended 31st of March 2020. So how much is that? It is 12,800. It is 12,800. So this, or whatever we get here, is the amount of current tax which will be charged in the income statement. So this one will be deducted from the profit before tax for the current year. And that is what? That is 101. That is one what? 101. Is that what you're getting? That's what you're getting? That's what you're getting, Naomi? Noor, Martha, is that what you're getting? Virginia, Zipporah, is that what you're getting? Lucia, is that what you're getting? Yes, yes. So then from there, can we go to the last paragraph, the last paragraph of note number 3? In the last paragraph of note number 3, we are told, as at 31st of March 2021, that is at the end of the current year, Babu Limited net asset, the tax base of Babu Limited net asset was 292 million less than the carrying amount. The income tax rate is 30%. First of all, this amount of 292, which basically is the difference between the tax base and the carrying amount, which name is given to that? Which name is given to that? That difference between tax base and carrying amount of net assets. That difference, which name is given to that? I see whether we are together. Which name is given to that difference? To that difference between tax base and carrying amount. The name given to that, that is something you have just done here. We should not forget. That is something you have just done here. That is a temporary difference. That is a temporary difference. So in that case, the 292 is a temporary difference. But in this case, we need to determine, is it taxable, is it deductible? Because in our case, we are told that the tax base TB of the net asset was 292 million less. So this was less than carrying amount with an amount of 292 million. Remember, we are working with all our figures in thousands of shillings. Now, what we need to do is to determine automatically these are temporary difference. These are temporary difference. So what we need to do now here is to determine whether this temporary difference, is it taxable, is it deductible? Is it taxable or is it deductible? Remember, you said that in computation of what? Of a temporary difference, we take carrying amount minus tax base. If you get a positive figure, it is taxable temporary difference. You will only get a positive figure if this one is if this one is greater than this. So taxable temporary differences arises whereby carrying amount is greater than tax base. If you get a negative figure, it basically means that this one is greater than this. So that one is known as deductible temporary difference. So whereby this one carrying amount will be less than tax base. Will be less than tax base. That's basically what you need to remember. So we are going to use these rules here. If carrying amount is more than tax base, it is taxable. If carrying amount is less than tax base, it is deductible. But in this case, you can see the examiner tried to cut you. He started with temporary difference. So we can interchange. We start with this carrying amount. So once we start with the carrying amount, what happens to our inequality sign? Well, this known as the inequality signs? Yes, inequality sign. So which is this less than, it will change to what? It will change to what? Can you be able to remember what you were doing in high school? It will change to greater than. It will change to greater than a tax base. Is that correct? Yes. So this will be greater than this one with an amount of 292. So if that is the case, what is this? This temporary difference. Carrying amount is greater than tax base. Carrying amount is greater than tax base. So this one is a taxable temporary difference. So if it is a taxable temporary difference, then what this company will recognize at the end of the year is something called a deferred tax liability. The deferred tax liability, which basically at the end of this year, 31st of March 2021, and this one will be equal to the taxable temporary difference. We multiply this with the tax rate. We multiply that with the tax rate. Sasa? Yes. So our taxable temporary difference is this one, 292,000. And then still in that point, we are given the tax rate. Can you see the tax rate? Yes, the tax rate is 30%. So this will give us what? This will give us what? This will give us an amount of how much? This will give us a deferred tax liability of how much? Deferred tax liability of how much? Deferred tax liability of 87,600. 87,600. 87,600. Is that what you're getting? Is that what you're getting? Is that what you're getting? Yes, that is what you're getting. Now, this deferred tax liability, remember these are deferred tax liability at the end of the year. Now, when this company or when preparing the balance sheet, the statement of financial position of this company, this amount here, which we have here, we recognize it in the statement of financial position as a non-current liability. This one will be recognized in the balance sheet of this company as a non-current liability, simply because this is a tax to be payable by our company in the future. The tax to be payable by the company in the future is what? Is a non-current liability. But still, if you go back to the balance sheet, not the balance sheet, sorry, in the trial balance, which we have under paragraph 1, I hope you can see we have another deferred tax. Can you see deferred tax in the trial balance? The deferred tax in the trial balance. Deferred tax. Can you see a deferred tax? It's just above the figure we were given for current tax. The deferred tax. Can you see the deferred tax within the trial balance? How much is it? That is how much? The deferred tax is an amount of how much? Is an amount of 97,600. Now, the first thing you need to determine is whether this is a deferred tax asset or is it a deferred tax liability. This amount of 97,600 at the start, because this one is at the start, is it a deferred tax asset? Is it a deferred tax liability? Deferred tax asset or deferred tax liability? Who can tell us whether it is a deferred tax asset or a deferred tax liability? Deferred tax asset, deferred tax liability. I'm told by that is a deferred tax asset. No. Now, can you remember this acronym? Can you remember this? This will save you a lot. There is this acronym which I gave you. Oh, you are saying, all of you are saying that is an asset. No. That can never be an asset. Now, we say if you're given a trial balance and you remember this acronym will assist you a lot. This acronym, which is DIDA, we say this basically stands for drawings. A company may not have drawings. Then this one stands for expenses. Then this one stands for assets. Now, all these items within the trial balance, because whatever you're given under paragraph 1, that is a trial balance. A trial balance, I hope you can be able to remember the format of a trial balance. A trial balance looks like this. A trial balance do have a details column, then followed by the debit column, followed by the credit column. I hope you can see that trial balance which we have at the paragraph 1. It has 3 columns: the details, the debit, and the credit. Now we said all these items, drawings, a company may not necessarily have drawings, but other businesses may have drawings like sole proprietorship, partnership, and drawings as expenses and assets, all these, they have a debit balance. So all these items, they appear in which column? The first column. There is no way you'll be given an asset here. There is no way you'll be given a liability here. That is not possible. Then L here, these ones stand for liabilities. These stand for equity. These stand for revenue or incomes. Now, all these items, they have a credit balance. They will appear in that word column. Can you remember this? This will save you a lot. Yes, because you can see, like in that case, the examiner has not specified. The examiner assumes you know that taking into account these items is on which column here. First of all, this item here, it is on which column? Is it on the debit or the credit column in that trial balance? It is on which column? Which column? It is on the credit column. So being on the credit column, there is no way it can be an asset. It can be an asset, never. Assets, they have a debit balance. So it is on the credit side. So being on the credit side, the examiner will not tell you is upon you to know that that is a liability. That is what? A liability. So therefore, this one is a deferred tax liability. That's why you can see the examiner will not even specify. It is a deferred tax what? Liability. It's a deferred tax liability. Is a deferred tax liability. A deferred tax liability. So therefore, now remember, we already have a deferred tax liability at the start of the year, and also the deferred tax liability at the end. Now, we have said this one will be recognized as an uncurrent liability in the balance sheet, in the statement of financial position. And then you can see we have a change in the deferred tax liability. At the start, it was this. At the end of the year, it was that. Now, generally, what we do when preparing the income statement, we consider what we use in the income statement is the increase or the decrease. Like in this case, what we do, we take this deferred tax liability at the start, compare that with the deferred tax liability at the end of the year, which is this one, and that is 87,600. So in this case, you may have an increase or a decrease. Like in our case, we have a decrease. A decrease of what? A decrease of 10,000. So a decrease in this case is known as a deferred tax income. Is known as a deferred tax what? Income. This is very, very important. This is very, very important. So therefore, this one is what? Is a deferred tax income. So therefore, can you put this note somewhere? So you say an increase in deferred tax liability, an increase in deferred tax liability is known as a deferred tax expense. Is known as a deferred tax expense. That maybe can be our note 1. Note 2, decrease in deferred tax liability. Deferred tax liability is known as deferred tax what? Income. Is known as deferred tax income. Like what we have here, we have said this is a deferred tax income. But if, for example, we had an increase, that one is called a deferred tax what? Expense. Is known as a deferred tax expense. Is known as a deferred tax what? Deferred tax expense. Sawa. Is that clear? Yes. That is clear. That is clear. I hope so. That is clear. I hope so. Then when preparing the income statement, how do we account for this deferred tax income? So I want us to just have an extract. So this is actually the first question we will start with in our next yes, I'll be able to explain that before. In case we come across deferred tax asset, maybe I'll be able to explain that because most of the questions will come across deferred tax liability, but I'll be able to explain that maybe when looking on more questions on the on published financial statements. So now, assuming, for example, in this question, we are preparing now the income statement, so which you're not preparing. So generally, what you do is that once you have computed the profit before tax, so which we don't have in our case. So to this, you come and you less or you adjust this profit with the income tax expense. The income tax expense. Now, if you can be able to recall on Saturday, we said the income tax, this comprises of two components of taxes. It